Let's take a deep dive into the various metrics that the finance team will have to look at. There are 3 terms that matter here: bookings, billings, and revenues. Understanding bookings is essential for understanding the health and the sales process of any business. Predominantly, bookings and revenues are misunderstood and oftentimes used interchangeably, even though these imply 2 totally different things. Bookings versus billings versus revenue, simplifying the top-line SaaS metrics. Let's understand each of these terms with a simple example. A SaaS help desk solution called Help offers 3 different plans: Startup, Growth, and Enterprise. Priced at $200, $500, and $1,000 respectively. Here's a sample dataset of their annual customer subscriptions. Bookings in SaaS. Booking is a forward-looking metric that typically indicates the value of a contract signed with a prospective customer for a given period of time. In a nutshell, bookings signify the commitment from your customers to pay you money for the service you provide. In the previous example, Customer A has signed up for the startup plan for 1 year. The contract between Help and Customer A that commits a service from the provider's end, as well as a payment from the customer end during the 12 months of engagement, is a booking. That makes the contract value of $2,400 a booking. For a particular month, your bookings comprise the sum of all the closed deals in that month, and the full duration of the contract should be considered. So in our example, monthly bookings for Help are various types of bookings includes new bookings, renewal bookings, and upgraded bookings. However, it is also important to understand annual contract value (ACV) bookings, total contract value (TCV) bookings, and non-recurring bookings. Why are bookings important in SaaS? Bookings are a primary indicator of future revenue growth. Bookings can help measure the growth of sales over time. You can derive insights about which prospects signed up for what plans or which salesperson was responsible for winning the customer, etc. Using these inputs, you can determine the effectiveness of your customer acquisition and possible upgrades. Bookings are one of the better SaaS metrics to evaluate sales success, as it estimates the revenue that is won by sales, including non-recurring bookings. This is particularly necessary as MRR, monthly recurring revenue, does not count in revenue from non-recurring charges. Another important aspect is converting bookings into recognized revenue. If your bookings are high and the revenues recognized are low, it's time to audit the effectiveness of your sales process and product delivery. Apart from sales, bookings is an important metric for CFOs and finance teams as well, to help in planning cash outflows and inflows. In effect, it helps finance teams to report bookings as committed money, without recording them as revenue, and thus avoiding inaccurate calculation of MRR or ARR, annual recurring revenue. However, David Skok, in his incredibly exhaustive post on SaaS metrics, points out, since the bookings number might have a mix of different durations, example month to month, 6 months, 12 months, this number is not very helpful for understanding the business. He goes on to add that you should look at the following components to make more sensible decisions. What happened with new customers, new MRR or ACV from new customer contracts? What happened in your existing customers? Renewals, churn, MRR, ACV, expansion bookings, the sum of all the above, net new MRR, ARR. Now, on the next metrics, billings. Billings are the invoice amounts billed to customers. This can be over a certain time period, like month or a full year. Simply put, billings are when you actually collect money from your customers. Let's get back to our sample dataset. You'll notice that some of the customers have subscribed to a monthly plan, while some others have subscribed to the annual plan. Now, while we calculate billings for customers with an annual plan, let's consider that they are paying for 12 months upfront. On the other hand, customers with the monthly plan are being billed every month. Billings provide insight into the health of a SaaS business because it's the money you're owed, revenue. Revenue is the income earned when you actually provide your service to the customers. For every month of successful delivery of service, you can recognize the revenue for that month. This is a per GAAP rule which states that revenue can only be recognized once it is earned. Coming back to our example, let's calculate the recognized revenue of Help for each month. By delivering the promised services to all customers for their respective months, Help has thereby earned the revenue during that period. Note that the revenue can only be recognized if the conditions laid out by ASC 606 are met. Now, there's another term you need to know about: deferred revenue. Deferred revenue. With recurring revenue comes deferred revenue. Deferred revenue is the money you've already billed, but you can't recognize it as revenue because the service is yet to be provided. In our dataset, that's simply billings minus revenue. This is a snapshot of just how different these metrics can be despite being related to each other. Reporting bookings, billings, and revenue. Now that we know what each of these terms mean, it's also important to know how they are reported in SaaS accounting. Bookings don't directly impact financial reports or income statements. Encouraging sales to enable prospects to pay upfront is a great way to increase potential cash flow. Billings, on the other hand, affect the balance sheet, which includes deferred revenue, accounts receivable, and cash balance, and the income statement, which is recognizing revenue over a period of time. As far as revenue recognition goes, ASC 606 provides an overarching framework to recognize and report revenue that's applicable across industries. Revenue recognition for SaaS businesses can be a tad complicated due to the nature of the business model. Now, there are a few other finance metrics that you need to know here. Current ratio, also called the working capital ratio, is a liquidity ratio used to measure a business's ability to meet its short-term liabilities. It compares the firm's current assets to its current liabilities. So here's how the current ratio is calculated. Current assets include cash, inventory, accounts receivable, marketable securities, and other current assets that can be liquidated and converted to cash within 1 year. Current liabilities include wages, accounts payable, taxes, and the current due portion of a long-term debt. A current ratio that is lower than the market average indicates a high risk of default. A current ratio that is way above the market average indicates inefficient use of assets. There's another ratio that we also need to understand: the SaaS quick ratio. The SaaS quick ratio measures the growth efficiency of SaaS companies. The formula is pretty straightforward. The measure of net monthly revenue inflow, MRR growth, by the revenue outflow, lost MRR. Let's take an example to illustrate this metric. There are 4 companies, A, B, C, and D. Consider the following values for the quick ratio calculation. The net new MRR is $5,000, new plus expansion minus contract plus churn, in all scenarios in the above examples. Yet Company A fares better than the rest since it makes that revenue with much less effort than the other companies. To further explain, Company A makes $6 for every $1 lost, whereas Company D makes $1.25 for every dollar lost, which is only a 25-cent gain. When the contraction is almost the same as expansion, it takes more effort to improve revenue health. Hence, the higher the quick ratio is, the better. Difference between quick ratio and current ratio. Both quick ratio and current ratio are indicators of a company's liquidity. The fundamental difference between both is that a quick ratio is a more conservative indicator of liquidity. The current liabilities taken into account in both cases are the same. But for the current assets part, the quick ratio doesn't include comparatively less liquid assets like inventory, prepaid expenses, and other current assets that are less liquid.